Wouldn't it be nice if there was a way to hold hundreds or even thousands of different positions within your portfolio without having to spend the time and energy picking and choosing every single stock that you're interested in? And you know what? Let's have this magical concept all be grouped up into one single easy to purchase security for cents on the dollar in management fees. If this sounds too good to be true, well, think again, because today we're going to be exploring a handful of exchange traded funds, or ETFs for short, that you can add to your portfolio in 2020 for further diversification and exposure to some specific markets and industries, and especially with what's going on right now in the financial markets having taken somewhat of a dive over the past week or so. Well, obviously ETFs have followed suit, and right now you can pick a variety of them up at a total steal. Hey, what's going on, investors and savers? I hope you're all having a great weekend. If you're new to the channel, then welcome. My name's Griffin, and in today's video we're going to be speaking about one of our favorite topics here in this community, and that is exchange traded funds, or ETFs for short, which I'm sure you're already well aware of. Now, if you're new to investing and aren't entirely sure what an ETF is, or if you just want somewhat of a refresher as to how ETFs can benefit your portfolio, then I would highly recommend that you check out the video that's overlaying right here, and or there's videos down in the description that I've linked where you can really just get up to speed with what we're speaking about here in today's video. I'd also like to mention the fact that in today's video, the ETFs we're going to be looking at are a lot more industry or market specific rather than what I would call core ETFs, which are typically going to have holdings that are a lot broader within an entire market, for example, and are going to be more suitable to create a nice foundation for your portfolio. That's not to say that the ETFs we're going to be covering in today's video aren't going to be suitable for your portfolio. Rather, just if you're new to investing, you might want to focus on adding some core ETFs to your portfolio first, which are typically going to be either S&P 500, total US market, and or total Canadian market ETFs, which is going to be more of a long-term steady foundation for your portfolio moving forward. So with all that said, in today's video, we're going to be diving into 6 different exchange traded funds that I've identified, which are currently at a lower price due to the market taking somewhat of a hit last week, and are also going to be able to provide your portfolio with further diversification and dividend income moving forward. 3 of them are going to be on the TSX, and then 3 of them are going to be listed on American exchanges. And if at any point in today's video you're enjoying the content and it's providing you value, then make sure to give it a thumbs up. It really helps the channel grow and reach more people. And also consider subscribing if you're interested in seeing more investing style content. Alright, so let's debut today's video starting with the Canadian positions. The first ETF on today's list being the iShares Edge MSCI Minimum Volume USA Index. That was a mouthful, but anyways, it is also known under the ticker symbol XMU on the Toronto Stock Exchange. This is an ETF that seeks to track the performance of lower volatility US equities, which typically can have an impact on reducing significant losses during a market correction. However, with that said, currently this ETF is trading for right around $57 on the Toronto Stock Exchange, down from its market high of $62.50 on the 18th of February. So this could be an opportune time to swoop in and grab some shares while prices are low. If we take a look at the exposure breakdown, this is going to give us some further insight as to how the fund is constructed. So in first place, the largest weight for this fund is the information technology sector at 17.5%, followed by the financial sector at 15.6%, and then the consumer staples at 12.3%, which is all spread out over 208 holdings. Now, you're probably wondering what types of returns you can expect when investing in a fund such as this one, which is comprised exclusively of lower volatility positions. But I think you're going to be quite surprised to hear that since inception of the fund in 2012, the average annualized return has been right around 16.40%, which is quite phenomenal, especially considering the fact that right now it is sitting at a fire sale price and could very easily be a 5, 10, or even 15% position in your portfolio. The management expense ratio for XMU is relatively low for a Canadian ETF at 0.33%, and currently the distribution yield for this fund is 1.50% net of those management fees. I've personally picked up a handful of shares of XMU while prices are low, and if you're looking for a good candidate for some long-term steady appreciation within your portfolio, then this might be your ticket to that. Moving on now to the second Canadian ETF that we're going to be covering on today's list. It is the iShares S&P TSX Capped Information Technology Index ETF, also known under the ticker symbol XIT on the Toronto Stock Exchange. Now, typically this isn't the type of ETF that I personally invest in, and you guys all know that because I'm more of an investor who likes to invest in stocks and ETFs that are going to be paying out a nice dividend yield as well as being less volatile. However, with this current ETF, the price has fallen down to the $29 range from a $33 range only a couple weeks ago, and especially taking into consideration the stocks that are held within this fund, I really think that there's some potential for growth over the next year or so, and for that reason, I picked up a couple dozen shares last week. Currently, XIT only has 16 different positions, with 45% of the weight being allocated to application software, followed by 31% in internet services, and then finally, the third largest weight is right around 19% in internet consulting. The fund's largest positions in terms of allocated weight are Shopify at 31%, followed by Constellation Software at right around 23%, and then the third largest position is CGI at 19%. Basically, this is an ETF that's going to allow you to have some exposure to Canada's largest and fastest growing IT stocks without having to go and pick and choose which ones are of most interest to you. And with that said, the annualized average return of this fund has only been 5.52%. However, if we look at a long chart here, it's very evident that over the past 5-6 years, the ETF has really been booming. And this is really due to the fact that Shopify stock has been added to the fund, and then other stocks such as CGI and Constellation Software, the prices have really been rallying over the past couple of years. And for this reason, in 2019, for example, XIT has shown a 60% return, which is just absolutely phenomenal. But nonetheless, I have quite a strong feeling that this ETF is going to continue going up in value over the coming years. We're just going to have to see, but also considering the fact that right now the price of it is extremely low, this can be a great time to get in. The management expense ratio of XIT is a little bit higher than the last ETF we looked at 0.61%, but with that said, I still think that it's worth it, especially considering the price that you can get shares at right now and the overall exposure to the Canadian IT sector that this fund is providing you. And finally, last but not least, for the Canadian ETFs, this one is a little out of the ordinary compared to some of the other ETFs we looked at in today's video and previous videos. It is once again offered by BlackRock, and it is the iShares Global Water Index ETF, also known under the ticker symbol CWW. This ETF exposes you to 50 different international players from developed markets that have an active role in the water industry, from anywhere from water utilities all the way to infrastructures surrounding water. CWW currently trades for right around $39.50, having dropped from its high of right around $43.30 in mid-February, and has a 12-month trailing distribution yield of 1.40%, taking into account the 0.66% management expense ratio. If we take a look at some of the top positions within this fund, we have in first place American Waterworks, followed by some other really great companies in the water industry, such as, for example, Geberit AG and Danaher Corp. Since inception of the fund, CWW has provided investors with an average annualized return of 7.31%. However, in more recent years, such as, for example, since 2015, the average annualized returns per year has been right around in the 13% range. It's honestly kind of difficult to pinpoint just where this ETF is going to be be going in the coming years. But if we take into account the fact that over the last years, there's been some nice annualized returns, and the fund is comprised of some solid companies in the water industry. And currently you can get this ETF at a relatively low price. If you're interested in an ETF that's going to offer you some further diversification into an industry that gets little attention, this might be the right option for you. Now that we've gone over some great Canadian listed ETF options, let's take a quick trip down south of the border in order to explore a variety of different American listed ETFs in case you're looking for some varied investment options, or if you're American yourself and you're going to quickly notice that the management expense ratios of these American listed ETFs are much lower than Canadian ETFs. The first US listed ETF that we're going to be looking at on today's list happens to be in the same vein as one of the Canadian ETFs that we looked at, and that is the Vanguard Information Technology Index ETF, which seeks to track the performance of the US information technology sector and currently has 323 holdings within the fund. Some of the largest positions within this fund include Apple, Microsoft, Intel, Visa, MasterCard, and others. And just like the majority of these stocks, this ETF also took quite a hit over the last trading week, going from $273 US at its high all the way down to $235 as of last close. Since inception of VGT back in 2004, the average annualized return for this fund has been 10.97%, but over the past 5 years or so, it has been more in the 18% range, which is absolutely phenomenal for investors, especially considering the fact that the management fee for this fund is 0.1%. To be expected with stocks in the information technology sector, the distribution yield for this fund is not all that high at 1.15%. However, if you take into consideration the fact that the management expense ratio is only 0.1%, combined with the steady appreciation in the 18% range over the past 5 years, as an investor investing within this fund, you're not necessarily looking for dividend yields anyways, so this is still a great fund to invest in. If you're personally looking for diversified exposure to American securities in the IT sector, then make sure you check out VGT while share prices are at a discount. Moving on now to the second US listed ETF that has taken quite a hit over the past week or so. It is the iShares Russell 1000 Growth Index ETF, also known under the ticker symbol IWF. This ETF provides investors with exposure to US companies whose earnings are expected to grow at an above average rate compared to the market, and is comprised mainly of large and mid-cap companies. The ETF was trading for $192 US as of mid-February, and right now you can pick up shares for $169. So if you're looking to expose yourself to some securities that can have above average growth over the next year or so, then make sure to pick up some shares while prices are low. IWF currently has 530 positions within the fund and has a 12-month trailing yield of 0.97% net of the 0.19% management fee. When taking a look at the exposure breakdown and the individual positions held within this fund, well, kind of to be expected here with a fund that's focus is on higher than average growth. We have right now a 40% exposure to the IT sector, followed by a 14.8% exposure to the healthcare sector, which is actually a rapidly growing company. And then finally, the third largest position here is in consumer discretionary at 13.7%. Over the past couple of years, returns for this fund have been absolutely phenomenal in the 20 to 30% range on average. So with the fire sale price right now, this should absolutely be an ETF that's on your radar. And finally, last but not least, the third US listed ETF that we're going to be looking at in today's video is quite a bit different than the other ones we actually looked at, and it is the SCHWAB US Dividend Equity Index ETF, also known under the ticker symbol SCHD. This ETF currently trades for right around $52.20 as of last Friday's close, which is down 11.60% from the mid-February high of $59.20. SCHD mainly invests in large cap dividend distributing companies, and for this reason has a dividend yield of 3.32%. 35% while keeping expenses extremely low at 0.06%. The fund currently only has 105 total holdings at 20.7% in consumer staples, followed by 17.5% in IT, and then 16% in industrials. So unlike most of the other ETFs that we just looked at that were more heavily invested towards growth tech companies, within this ETF, you're gonna find players such as Home Depot, Coca-Cola, Pepsi, and Procter & Gamble. In terms of the fund's annualized returns, well, since inception, the average annualized return has been right around 12.2%, with in most recent years being more around the 8% range, which is still a nice return considering the high dividend yield that comes with investing in this fund. All in all for this fund, considering the extremely low management expense ratio combined with the current low price of the fund, this is a great addition to your portfolio for long-term share appreciation growth as well as dividend income. All right, guys, what did you think of the ETFs that we just covered in today's video? I'd love to know down in the comments your thought on each one of them, as well as which ETFs are currently on your radar. Also, if you're interested in learning more about how you can go about creating an easy to construct ETF portfolio, then make sure to check out the video right here. And if you want to learn more about some different ETF picks, then check out the video right here. So on that note, thanks a lot for watching, and I'll see you in the next video.